Let's welcome in Pankaj Tibrewal, Senior VP and Fund Manager Equity at Kotak Mutual Fund. He's now joining us. Good morning, Mr. Tibrewal. Thank you so much for taking out time for us. Could you just tell us about the earnings season so far? What do you make? Has markets already started to price in, faster than expected recovery?
So clearly, if you compare it with the third quarter earnings season post demonetization, we started on a very low expectation and a low base. Unlike this time in fourth quarter where markets have run up very sharply, the expectation has also risen, and hence a lot of stocks are already pricing in strong earnings recovery, as you rightly said. Till now, a handful of results have come in, and it continues to be a mixed bag. IT continues to report subdued numbers. Banking side, you have seen very strong numbers by some of the retail-oriented private sector banks. PSU banks yet to report numbers. Some of the private sector corporate banks, you are clearly seeing the management commentary coming out that this FY17 could be the worst year in terms of slippages and NPAs, and probably going forward in 18 and 19, the numbers could materially improve. So clearly it's a mixed bag. A lot of companies, especially in the mid caps, yet to report numbers because don't forget this is an annual year numbers as well, and hence you get 60 days to report your numbers. So we are keeping a wait and watch approach, but markets clearly pricing in a strong earnings recovery in the fourth as well as FY18 for a lot of companies.
Right. The corporate banks thing that you just mentioned, what do you make of the results of ICICI and Axis Bank, or rather the commentary that they said? Do you think that things can only look up from here on?
So clearly, without going into stock specific, the private sector corporate facing banks, the commentary which came out from all of them is suggesting that FY17 will be the peak year in terms of slippages and NPA formation. Probably 18 and 19, the credit cost should start coming down and probably mean revert. It may not happen very fast, but yes, the trajectory from here on will be downwards in terms of credit cost. Secondary, if you look at some of the banks which you mentioned have done a phenomenal job, or at least on the liability side, they have maintained their franchise very strong. The CASA numbers looks to be extremely strong. So once the asset side problem starts getting resolved, I think you can see a severe re-rating in these banks in terms of multiples. And most of the private facing corporate facing banks have not performed in the last 3 to 4 years. So that leaves enough room from a stock price performance as well.
Right. And what about, the retail-facing banks, or banks that are always expected to do well? Commentary of Yes Bank, IndusInd, maybe, even Kotak continue to, point out that there the growth is at least not slowing down, or the retail side is also continues to do well?
Yeah, I think the retail side continues to do well across the board, whether it be housing loan, whether it be autos, whether it be personal loans, credit card, and so on and so forth. So clearly that momentum is not slowing down. And one thing which has happened very clearly with the last 5-7 years in India is the credit bureau coming in, and due to which the retail scores are easily available with most of the banks, and hence the slippage problem which we saw in the previous cycle, especially on the retail oriented banks, doesn't seem to be the case this time around. So I think momentum continuing, slippages lower than the average which we have seen in the previous cycle, bodes well for these retail oriented private sector banks.
Right. But, everybody talks about corporate recovery, corporate banks recovering. That doesn't mean that retail will slow down. Both can also grow, something what we saw in 2005, 6, 7.
Absolutely. I mean, in our view, since 1954, the March first week data which RBI released on the credit growth, so credit growth was the lowest since 1954, right? From here on, with WPI inching to 6 to 7%, some sort of economic recovery started to take place. Our call is that the bank credit growth in FY18 could somewhere move to 8 to 10% growth. And now if you bifurcate that between corporate and retail, our sense is that the retail book should continue at about 12 to 15% as an industry-wide growth. and corporate, which used to be flat or very low single digits last couple of years, should start inching back because the working capital credit demand, as WPI commodity starts inching up, that similar corporate will ask for more working capital demand. So we are not seeing great big bang project demand still coming in the corporate facing bank, but I think the initial signs of increase in working capital demand is clearly visible, with commodity pricing inching up, with slight economic recovery happening at the ground level. So you should see bank credit growth moving on an average 8 to 10% in FY18 compared to low single digit which we saw last year.
Right. In terms of corporate growth picking up, where do you think that pickup will come in from? You think infrastructure, cap goods, cement, they have to lead the banking credit growth pickup?
So one which I said is the working capital demand. Clearly, you have seen WPI, which was used to be in negative territory for last 2 years, is moved to 6-7%. That itself means the entire commodity basket has moved up, which will spur incremental working capital demand. Second, our sense is that the deterioration which we were seeing on the infra/capital goods size has somewhat got arrested. We are very excited about the order inflows which has happened to a lot of capital good companies in the month of March, and that momentum seems to continue in April as well. Road seems to be doing as a sector extremely well. You seem to be, when we speak to most of the road companies, they seem to be suggesting us that the order momentum is very strong. Similarly, on the railway side, I think you are seeing strong momentum coming across the board. Third sector where we are excited and we see pickup happening is the power T&D space, not the power generation space, but the power T&D space. When you combine these 3-4 sectors along with some kind of a brownfield expansion which a cement company is planning or maybe a steel company is planning, I think a part of that bank credit growth can come from there as well. But the big bang capex kind of a growth which we saw from 2003 to 2008, which was mainly led by steel, power, is not going to happen in this cycle. It's been taken over by something called railways, roadways. It's been taken up by urban metro. It's been taken up by urban infra, and so on and so forth. So I think the composition will change, and from here on, I think we have seen the worst in terms of bank credit growth. As I said, it was the lowest since 1954. Last March, the number which got reported. From here on, the trajectory should look upwards.
Right. In terms of banking names, one thing that has changed is the NBFC valuations as well. What do you think markets have suddenly noticed in these NBFCs in the last 2 years? Do you think the management quality, the sort of reporting that these banks have, some of these NBFCs have done, have been at par with some of the private banks? That's why they have been re-rated?
So clearly, market has got infatuated with growth, clearly, and you have seen NBFCs, some of them which are retail oriented facing NBFCs delivering very, very strong growth over the last 2-3 years. On the other hand, you had a whole host of banks, including the private sector corporate banks as well as the public sector corporate facing banks, which were struggling in terms of asset quality and growth. So you needed an alternative in the financial space, and I think NBFCs fitted quite well in that space in terms of filling your weight on the financial sector. So I think that was the reason that people found growth in a lot of those NBFCs, and those NBFCs got re-rated. But however, at this point of time, I think there needs to be somewhat of extra caution which should be there in terms of NBFC valuations. I think a lot of them are pricing in for a regulated business generating 18-20% ROE or maybe slightly higher, maybe 5 times, 6 times price to book, which I think is at a risk because you are not buying them cheap. You are buying in expectation that the growth, a very, very strong growth can continue for a very long period of time. And there where our caution comes in, you need to be very selective in selecting NBFCs because ultimately some of the NBFCs are doing run-of-the-mill business. Beyond a point, the size becomes a problem for most of the NBFCs and growth starts struggling. So one needs to be a bit cautious today on microfinance and select NBFCs because the valuations have run up too fast, too soon, and they are looking pricey.
Right. What do you do with pharma? Do you think valuations after the recent correction there are looking interesting?
So we believe that one should approach this sector very, very stock specific. I think clearly you saw a lot of discrepancy in this sector in terms of stock price performance. So let me give you a few examples. So in December 2015, one of the domestic pharma companies got listed, and since then that company has given more than 100% return. But when you look at from that date till today, which is more than almost 1.5 years, a lot of large Indian generic pharma companies have given negative returns. Similarly, there are a couple of other names where the pharma stocks have given very great results. So our thought is that this sector is going to be very stock specific. The same tide which we saw for 3-4 years from 2002 to 2000, or maybe slightly later than that, till 2013-14 may not come very fast. However, I think the worst probably would be coming to an end in next almost 6 to 7 months, where most of the FDA pending inspections would be over. US would settle in terms of pricing a bit, and hence people would start looking at FY19 and FY20, and then where the upsides on most of the pharma companies starts coming in. So if one was to invest in pharma, I would suggest that please go in a SIP mode, keep buying, accumulating stocks in pharma over the next 6 to 12 months and wait for that upside to happen. But don't hurry up, don't rush up and just buy it, because still the FDA risk room's large. Rupee appreciation is hurting you again. Third is the US pricing and some investigation by DOJ in some of the generic pharma companies is US putting pressure on the business. So wait and do a SIP kind of investment if you want to in pharma, but don't hurry up and do a lump sum investment.
Right. Also, I just wanted to understand about pharma. Now, till now, the growth was, if you just take an example of Sun Pharma or a Lupin, their base in US was very small. They kept doing their R&D. They started getting their approval, and suddenly US, which is a high margin business, really became a big part of their portfolio. Does that continue to be the theme? Identify mid-cap companies with small exposure into US who are doing some R&D? Or you would want to play, some of these companies where there are FDA issues in their main plant right now, but you trust the management because of the history that they have, and trust that they would solve it within the expected time?
So it has to be a combination of both, in my view, in some of the run-of-the-mill products. And small market share shifts can lead to significant growth for these mid-cap companies which have smaller base in US. So that's one way to approach. The second way to approach, as you rightly said, that in most of the large pharma companies and Indian pharma companies, there are some kind of problems on US FDA. One has to kind of figure out, are these problems serious? How long can it take? Maybe it can take 6 to 12 months, maybe it can take maybe longer than that. And then try and see that what is the market pricing in today. We believe that most of the Indian pharma entrepreneurs are very strong. They have run a very solid business, and clearly this opportunity, when it comes at the expense that there is some plant under US FDA investigation or observation and they are rectifying it, would be a sweet time to go and buy into those stocks, provided the valuation is offering you a decent upside as well. So I think it has to be a combination of both, the way you rightly put it, in terms of choosing a stock. Plus the third also filter, I would say that the Indian pharma space is also doing extremely well, the domestic pharma companies I mean, and looking at some of the valuation of MNC pharma in the domestic market is really lucrative, I think. So they are, investors are worried about government's push towards generic in the domestic business, government's push towards price control through NLEM and so on and so forth. But at some point of time, I think a lot of these MNC pharma companies which are operating in India starts becoming attractive on valuations, on cash flow, and probably there could be a time to relook at those names as well.
All right, Pankaj, would the case be similar for IT majors as well? Now, there is a marked deviation between some of the mid-cap IT companies in the stock prices. I'm not talking about the performance, but just the stock prices. We've seen some mid-cap companies like Hexaware and IT Tech, stock prices come close to 52-week highs. But the heavyweights like TCS and Infosys are languishing. Do you think the case for technology stocks is somewhat similar to pharma stocks? You're expecting some resolution in the next 6 months for pharma stocks. For IT stocks, is it the same, or the situation is different because the business model is now going to be different? And of course, you have challenges about visa and currency in the US.
We believe that the business challenges in IT is quite different from that of pharma. The business challenge in IT is more of growth because their core legacy business, the work is shrinking. And let's accept it that the mantra today, and not from today, at least for last 3-4 years, is that less effort for the same kind of a job. And clearly the world is moving towards that more productivity. That means more automation, more towards artificial intelligence, more towards other themes, where these large companies have been slow in terms of investing or recognizing it. And there's still a large portion of their business is still the services business, which in our view is slow growing and has a pricing pressure across. So when you have that environment, probably the growth challenges would remain for some more time to come. It's not something where that growth depends on some external, like in pharma on FDA or something, but here there's a clear-cut business challenge. The fast-growing space like your IoT, the digital, the artificial intelligence, the 3D, the blockchains and other things are a very small portion of your overall business today. So even if it grows at 25-30%, still the growth, which is the large legacy business, will pull it down, and hence your company average will not be in double digits still. Compared to that, some of the mid-cap names, probably they are more nimble and fragile, and their base is not as high as some of the large-cap companies. And hence our belief is that, again in this sector, if you're a good stock picker, and you can pick up companies which can grow their revenues by 12-15%, not anything more than that, I think there could be a reasonable upside in those names. Third, I think currency is hitting them again very bad. It comes at a time when your top line is under pressure, plus your currency also hits you, and hence your earnings growth becomes very subdued. So clearly it's a combination of everything which is making us stay underweight on this sector. Valuations optically look very attractive, but somewhere we have to figure out, is it a value trap which can be there for some more time till the growth comes in and kicks in. So we have been very stock selective, but overall stance still on our portfolios remain underweight.
All right, so underweight on IT for now. How do you assess the entire metal space? We've seen quite a meltdown in commodity prices globally. It seems that the entire Trump reflation rally is just fizzling out. The data from China is not strong, and a number of metal stocks have started to correct. How do you approach the metal players?
Very, very rightly put. I think our worry is also the same. I think after 4-5 months of Mr. Trump being in office, I think there were a lot of expectations for growth to start picking up. There was a lot of hope that a lot of jobs would start shifting back to US, infrastructure spending would start, and so on and so forth. But as you rightly saw that, the first bill which this government introduced, which was the healthcare bill, had it opposition from its own party members. So it's not so easy what you plan and what you do. And our belief is that the reflation trade, which led to commodities clearly moving into a different sphere, probably is finding its reality back. So in commodities, we believe that the world global growth is not supportive in terms of demand. Plus on the supply side, you continue to have excessive supply in some of the metals like steel, in some of the metals like iron ore, and so on and so forth, where the pricing power may not come in again. What we saw from 2003 to 2007, I think it will be wrong on our part to anchor our expectation again to that previous cycle and expect that the commodity stocks and commodities underlying will continue to do the same which we saw in the previous cycle. I think that's not the case. We continue to be a little cautious because the overall demand supply dynamics doesn't fundamentally suggest us that one should be long commodities for a very long period of time.
Right. For the markets, what are your expectations? We've run up very fast since end of December. And, there seem to be some geopolitical global tensions playing up. This weekend, we have the final French election results to come through. Do you think the markets are poised for a correction? Because the corrections so far have been very shallow.
So there are two parts to it. I think if you look at calendar year to date, Nifty is up 13-14%. But if you look at in dollar terms, it's up 20%. And index is not only the right picture. Look at the broader market, what it has performed. In the last 4 months since 1st of January, in BSE 500, if you look at, there are 230 stocks which have given more than 25% return in last 4 months. And there are more than 70 stocks which have given more than 50% returns in the last 4 months. We believe that the money making can't be so easy, and hence at some point of time there needs to be extra caution what it used to be 4 months back. So our sense is that there could be some or the other reason which could lead to some near-term correction, whether it be a geopolitical issue globally, whether it be a Trump trade unwinding, the hope trade which we just spoke about, whether it be something led to domestic economy. We don't know the reason, but probably it looks like there needs to be somewhat of extra caution warranted in the near term. However, from a 2 to 3 year perspective, I think the trend line seems extremely positive still. From if one was an investor which doesn't worry about volatility, still investing at these levels should not make you a bit uncomfortable. But if you are you get worried about volatility in the near term, I think the risk reward clearly is unfavorable right now. More than 40% of the stocks are trading at 40x trailing PE. So that makes up a little worried in the near term. We don't know the reason what the correction could be, because the liquidity continues to be extremely strong. Both from the FI side, you saw $3.8 billion in the month of April itself, and from the domestic side, both in terms of SIP, STP as well as lump sum. So liquidity is the only argument people are giving in the market that market can stay elevated for a longer period of time. But when you look at from a risk reward perspective, from a slightly valuation perspective, we feel that near-term caution is warranted.
Right. So if there is a dip, would you then suggest investors to buy? If yes, buy what from here on? What from here on will give you decent returns over the next 2-3 years? Because like you said, you can't get 50-70% returns after the stocks have moved up so much. But if there is a correction, what can give you good 15 to 20% returns 2-3 years from now?
So clearly, we believe that there are two kinds of investors in India. One investors we believe are the investors which in paper are long term, but they get worried in the short term by the short term movements of market and track markets on a daily, weekly, monthly basis. For them, I think SIP and STP mode is the right mode to come into the market at these levels. There is a second set of investors, probably 2% or 3% out of 100, which we call the Kumbhakaran. So the way Kumbhakaran used to sleep and wake up after a long period of time, I think those investors which don't get jittery about the volatility are the investors again who can come at any levels in the market, because they will wake up after 3-5 years, and hence their return of 15-20% CAGR probably would be met. So you need to decide which camp you are in and accordingly decide your investment strategy. But at this point of time, we are not advising a big lump sum. If you get worried about the short-term volatility, come in the SIP and STP mode, and hence over a period of time you can make wealth, and have some cash handy during the time of correction as well. Because most of the time we see that when correction happens, people one get worried, and second don't have enough cash to buy stocks cheap or buy investment product on the financial assets cheap. So I think one needs to figure out that part on their discipline and then approach it accordingly.
Right. Just wanted to understand, the sort of changes that you've seen in terms of SIP investment and lump sum investment, the sort of, inquiry levels which have increased. Do you think mutual fund, financial BFSI is a bigger space than, banks and NBFC? There is a lot more opportunity into financial inclusion which could happen in the next 10 years, including businesses like mutual funds, different insurance businesses.
Absolutely. I mean, if you look at today what total assets under management under mutual funds are, including both debt and equity, it's about $270 billion, which is roughly about almost 10-12% of your total GDP. If you compare with any country globally, and especially US, you are at 55 to 60% of your total AUM as a percentage of GDP. So we have a long runway for growth. And what has happened is the other asset classes which people had fancied a lot over the last 5-7 years probably now looks not so lucrative in terms of returns, whether it be real estate or gold. And now people have figured out that in paper real estate offers great opportunity, but when you go and liquidate that, there are probably no buyers at this time. So people are realizing to the fact that their financial assets, which is a very small proportion today of your Indian total financial or savings pool, I would say, has to increase over a period of time. Just if you do the maths over the next 5 years, if you just compound your mutual fund assets by 17% on an overall basis, the industry in the next 5 years would be managing close to $600 billion, which seems to be a respectable number. Clearly the SIP inflow continues to be strong. People have realized one thing, that the money making by directly investing into equities, if you don't have the enough research manpower and if you don't have the time, probably out of 10 stocks you pick, 8 will be lemons and 2 will be the only multi-baggers, and those multi-baggers won't stay for a long time because in the name of profit booking you will go and sell them. So I think there is a lot of realization among when we meet the retail community, when we meet the HNI, and clearly at every dip they want to be the part of this financial inclusion which is taking place in India. And clearly after demonetization, I think the pace has clearly picked up. The formalization of this financial services we are clearly seeing, and everybody is waiting for a bit of correction where they can kind of come in a lump sum as well. So I think the wave has just started. It's a multi-year trend in our view in terms of financial services and financial inclusion as a theme. And we believe that 2-3 years should not be just saying that the thing has just finished off. I think it's a multi-year themes to watch out.
Right. Also, just a point, as a fund manager, the sort of money that you're getting, is it difficult to find ideas in such a market? And also you have a mandate that beyond a point you cannot keep cash. Is it getting difficult to find ideas, or you think that there are still a lot of ideas with the bottom-up approach if some fund manager wants to approach in the market?
So if you take a overall approach, what you're saying is right. After the very sharp rally, so what was our stance 4 months back, probably very positive, is now turned to a little bit cautious. So clearly there is a lack of enough ideas. But having said that, I think the way we are approaching some of our portfolios is that have some allocation, maybe 15-20% to stocks which have not done too well in the last 3-4 years. The franchise of those stocks remains still very strong, but because in the last couple of years, because of earning mix or valuation having a time correction, these stocks have not given any great returns. And we are finding few stocks in every sector where the franchise is still strong, but the upside has not been captured in this rally. And hence we believe that even if market correct, those stocks won't correct by more than 10%. So that's our approach, that in any new stock we are picking up, we are first asking the question that how much is the downside rather than upside. And there are a good handful stocks which probably are finding in that criteria, which probably is fitting our 10 to 15% of our portfolios. And we believe that incremental money is getting deployed there. You rightly said that we don't maintain too much of a cash. As a house, probably 7 7.5% is the max cash we can go up to, and hence the constant need to figure out some of the stocks where downside is less and upside is more, and that's a constant phenomenon.
Right, Mr. Tibrewal, thank you so much for taking our time for us. Always good to get a perspective from you. There was a view coming in from
Thank you
Kotak
so much.
Mutual Fund. Cautious, but look at stocks where downside is limited and upside is slightly higher, even when valuations are at where they are.